Okay. So, how did you guys think of the test? What did you think about it? Was it good?
A lot of info in there. It's good.
I don't think it was as hard as I expected.
Okay. Well, you must be a genius then, man. So.
I expected a lot worse.
Okay. Well, that's a good sign. So I want to dive into it. We'll go over it, and normally what we'll do is, start from the back and work our way up. Some of the more harder questions are towards the back, and I don't know if everyone. I don't think everyone. Well, some people didn't get to the back. Some people did. I know B, you didn't get to finish it, but we'll go through it now and discuss it. So the first one, number 210. So for a rescore, a borrower cannot go under contract until this is done unless the borrower already qualifies with a current score. So what does this mean?
It means the rescore has to be done before they even go on contract.
Right.
So,
Why is that though?
because once we get a contract, it's pretty much straight into processing, and we're not really figuring anything out. It's just
Yeah.
straight into processing. Let's go.
The other thing is that so let me explain what this means. So when you're pre-approving someone and you need to rescore them, that rescore has to be done before they go under contract. Okay. So unless they already qualify without the rescore. See, if they qualify already and you're just trying to get their score up higher, then that's fine. But if they don't qualify and you're doing a rescore on them, then they cannot go under contract. Okay, and why am I bringing this up? Because there was a couple loans that they tried to submit today where the guys had 580 credit and they're under contract, and they said, well, we're just ordering a rescore, we'll get it in. And the thing is that the rescore is not a guarantee. There's no guarantee on a rescore. So you can't turn in a loan into processing until the rescore is done, because at the same time that you're rescoring the credit, the borrower could go out and charge something else up, or a new collection could come up with their credit report and completely offset what you're trying to do. So they don't. Rescore is not a guarantee. So that needs to be done. You know what a rescore is?
That's basically where you do the rapid rescore, right?
Mm-hmm.
So maybe you open up a secured line.
Secure card, paying down account.
Authorized
User.
user.
It could be Well, you can't do a rescore for an authorized user.
Okay.
So, but let's say that they have a credit card they're paying down. So just want to make sure that we're clear on that. That unless the borrower already qualifies, then you can do the rescore and they can go under contract. But if they don't qualify, then they can't go under contract.
Gotcha.
So okay, so that's what that's saying. So this is a good one right here, number 209. In order, we're starting from the back.
Oh, the back.
Yeah,
Okay.
yeah.
Cool.
In order for an amended tax return to be acceptable, it must
Oh, I stopped at 150.
it must be the return transcript showing the amended tax return has been processed for self-employed customers, and W-2 wage earners is faster to get the tax return stamped at the local IRS office. So let me read that again. In order, if somebody's going to amend their tax return to qualify for the loan, okay, for whatever reason, whether their income wasn't correct, whether they made a mistake, well, it's not a matter of them just sending you a new tax return. It actually has to be it has to actually go through the IRS system and show through their transcripts that it's been amended. So if they say, hey Joe, I got the amended tax return, can we close now? Well, it doesn't work like that.
Right.
So it actually has to go back to the IRS, and that's a 6 to 8 week process. Okay, so, and it's very, very important that you understand this, because if you're dealing with a W-2 wage earner, there is a workaround where they can go directly to the local IRS office and just get it stamped right there, and we can use that. Okay, but if it's for a self-employed borrower, the transcript actually has to show that it's been amended. What happens is that what we do here is we actually pull the tax transcripts, and it'll show if the amendment's been done or not. If it doesn't show the amendment's been done, then we cannot use it. And so, so it's real important that the whole point here is this, that when you're initially talking to the customer and you know that for whatever reason there's an amendment needed, then that means that you need that lead time to go under contract. You see what I'm saying? Because if it takes 6 to 8 weeks for a self-employed person to amend their tax return for whatever reason, then that means that you need that much time either built into the contract or prior to them going under contract. You see, if they're a W-2 employee and they say, well, you know, you need to get it amended, then they can just go down to the office and get it done right there in one day. So it just, you got to know this because it'll make all the difference if you can, you know, whether you can close your loans or not on time. And so, and this is going to come up. We have a lot of loans where people amend their tax returns for whatever reason. They have the incorrect information, you know, whatever. So this does come up. As this, I mean, I know it's hit you, and then it's hit a few other people. And so, so that's what this is talking about right here. Does everyone understand what I'm saying? You understand? You get it? You understand what I'm saying? Okay. Okay. 'Cause I want to make sure you guys get this stuff because your level of understanding of this is it's gonna show up in your paycheck, how well you understand this stuff. Right now, when you guys have been training, I've been doing a lot, you know, management has been helping you guys out a lot, but we're gonna start to wean you off. So, like, you know, some of you guys have gotten loans through the system. Well, that's management's not gonna be there to do that 100% anymore. You know, we have to slowly wind down because we bring in new people, we have to train the new people. And so a lot of these things are going to be, you know, your responsibility as your tenure increases here, that you're going to be responsible for doing. And so that's why we have to make sure that you get this. Like, see how the senior loan officers, no one bothers them, they do their thing. That's how it works. I don't ever talk to John, I don't ever talk to David. They already know what to do. That's in a few months. That's how you guys are going to be. You know. And because it's an entrepreneurial type job, and I don't get involved in their stuff. They handle their business. They come here and make their money, you know. And so in the beginning, we offer a lot of support, and the support's always there with the LOAs and the processors and everything like that. But like my role is not to be like sitting right behind you. So I want to make sure you guys understand that. So we're here to make sure that you guys get this information in you, and that way you can be successful and you can become a senior loan officer too. So, if a borrower has 2 jobs, how long do they have to have 2 jobs before we can use that income?
2 years.
2 years.
So what does that mean, Sean?
I'm not sure.
Let's think about it. I mean, Brandon, if a borrower says, "Hey, I got 2 jobs," what's the question going to come to your mind?
My first question is, how many hours? I'm going to calculate the hours, you know, and see if it even makes a difference. Because if you're working like 10 hours a week, you know, it's not really going to make a difference as far as the second job, you know, and you get the debt to income ratio. Then it has to be consistent for the 2 years in order for us to even count it. So first thing I'm going to ask is, you know, how long you working at the other job? How many hours?
Okay.
To try to figure out get a clear picture of what's going on. And then I'm gonna be conservative. I'm gonna use just the base on it, just the hourly.
Okay.
We're gonna find out how long they've had the jobs.
Yeah. So the main thing is when someone tells you, "Well, I have 2 jobs," and then they have to have a 2-year history of having 2 jobs consecutive. It doesn't have to do with the same companies, but they have to have a 2-year history of having 2 jobs consecutively. Let's say, well, you know, whenever you're talking to them, say, "Well, Joe, I make $200,000 a year." Okay, well, let's see, what do you do for a living? Well, I have these 2 jobs here. I'm a vice president of this company over here, and then I've been there for 4 years, and then I just started at this other company as a consultant. We can't use the consultant income.
Yeah.
See, because he doesn't have a 2-year history. Now, if he says, "Well, hey, Joe, I was a consultant over here for 6 years, and now I came over to this company to be a consultant too," and he was doing the primary job, then you can use it because you have a 2-year history of 2 jobs.
How so? Like,
Because he was a consultant at another company
Right.
prior. So all he did was swing from this company to that company.
as long as it's in the same industry.
Okay, I didn't know that.
Yeah.
So what if we have a guy, because I have a situation like this, where we have a young lady who, for instance, she's a college student. So she's worked as an intern and she's now offered a part-time position with the company. She's been working there for 4 years
As a intern?
as a part-time, well, between combination intern and now
Okay.
part-time
Okay.
employee.
Okay.
But that's part-time.
I got
And it's not sufficient to get her qualified, but now she has a new job that she's only worked for a year and 1 month.
Okay.
We just
And
qualify her on the year and 1 month job.
is that the higher of the two incomes?
It is the higher, she
Yeah.
works for the most part 35 hours a week with that new job.
But she wasn't, was she running both jobs at the same time? The
Not for 2 years.
Okay.
Only for the last year,
Yeah.
the year and 1 month.
Yeah, I understand. Yeah, the only thing you can do in that situation then is use the higher of the two incomes.
Yeah. Which is what we did with McGrade, and then we had to bring in her fiance.
Right.
Because we couldn't
You
use-
guys understand what he was saying on that? Okay, yeah, because that's an important one right there. So if a borrower works for a staffing company, how long do they have to work for a staffing company for?
2 years.
Yeah. 2 years. Now, what if they don't tell you they're working for a staffing company?
Look it up.
Oh,
No.
you have to ask.
Yeah, you have to. Yeah, you gotta ask. And sometimes it's not evident because the name of the company isn't staffing. It's, Gallery Furniture, and then you find out it's a staffing company. I mean, I've seen this weird stuff like that, man. And so you gotta find out. And a lot of times, they'll say something in the pay stub, or that you may. It's good to ask the person, but if it's a really renowned company, maybe they don't have that, but it won't be a staffing company.
Here's a situation in New York. Guy gets hired at his current employer 3.5 years ago. But his first 8 months, 6 to 8 months, he was with a staffing company. They hired him on full time,
Yeah,
like 8 months later.
right.
We can use that full tenure as time on the job.
When he was as an employee,
Mhm.
yes, yeah, because
Okay.
he was hired on by the company. That's fine. If you're hired on by the company, that's okay. That's what really what you want is them to be hired on by the company, or the 2 years of the 2-year history.
Because his W-2 does show the staffing company, from 2014. Part of the year he was with them, as well as part of the year he's with his current employer.
Right,
So,
right. Yeah. Okay. So if somebody has thin credit, how do you boost their credit score?
Rescore, right?
If they have thin credit,
Thin.
yeah.
You want to add rental history and
Oh, the term threw me off. Thin credit.
Mm-hmm.
rental history, a secured credit card, right?
Mm-hmm.
Authorized user.
Authorized
Oh, you
users.
can.
Alternate trade lines.
Which is- you say secure
What
credit
are, what are
card?
some alternate trade lines?
You said rescore.
Oh, yeah.
I thought rescore.
Yeah,
Yeah.
Anything secure. Okay, my bad.
A Netflix account? I guess anything.
Anything
like that,
that doesn't show up on the credit report, if we can prove that they've been paying on it for like 12 months or longer.
no?
Yeah. So if they have that Netflix for like 3 months, I mean, can't
It's got a
really
good 12-month history.
try to get 12 months history, build up that credit
Cell phone
profile.
bill, I guess.
Cell
Well,
phone
that
bill.
was it.
Those are just all trade lines.
Yeah, those are all.
trade lines.
We're talking about stuff you can actually add to the credit
Right.
report.
Credit
So.
report, yeah.
Like rental history, anything that we can get to report to the bureaus, authorized users. Authorized user can be very powerful if it's a long-standing trade. It has a high credit limit. If it's a good account, that can be much more powerful than a secure credit card.
Mhm.
If someone has like a $20,000 Visa with a $1,000 balance or whatever, that can really make a big difference. Now remember though, with USDA, if you do add an authorized user, then the person that's adding has to either be the spouse or be living in the home for USDA. If they're not, then it downgrades it to a manual underwrite. So only FHA will allow for an authorized user for non-occupancy or non-spouse with keeping it approved eligible. So, and that FHA video goes into detail about that, but you know, that's an important one. How
All
does
these things come up too. That's
Yeah,
the
they
thing
do.
about it.
They
All
do.
these things, everything we talked about so far. Crit Willis was that situation. USDA, had a authorized user, which was his mom, but his mom is not going to be moving into the home with him, so we had to get 2 alternative trade lines to
Yeah.
offset that.
because
Yeah.
it was manual, yeah. So what are the FHA flip requirements?
I know there's a 90-day season period.
What does that mean?
I mean, once you gotta wait 90 days before you can sell it. So it's not like you can just close on a loan, FHA, and 30 days later have someone else get a contract on the house and sell it that way. So there's a seasoning period.
Okay, so let's break that down. So let's say that Justin, an investor, he buys a dump house, right, fix and flip, and he buys it, today. Okay, so you fix up the house and then you try to sell it. You have to wait 3 months to sell the house before somebody can step in with an FHA loan to buy your property. Okay, now with conventional, someone can come in and buy your house within 90 days, but you can't max more than 20% profit. They won't, if you max more than 20% profit, then they won't let you do the deal.
So
Yeah.
conventional loan, someone can come in within 90 days,
Mhm.
buy the property, but you can't. net
But you
more
can't,
than
man,
20%.
and yeah, they won't let you make more than 20% profit.
Which
So-
defeats the purpose for that investor because he's
Yeah.
expecting more.
That's wrong.
Yeah, well, I mean, if you wait 91 days, then you're okay.
Yeah.
You know, so now with FHA though, from 90 to 180, you can do it, but then you have to order 2 appraisals, and they go off of the lower of the
Lower
two.
Lower of the
appraisal.
2.
Yeah, this is very important because if you don't grab these things up front, we had a deal. I mean, I'll just tell you right now with Fernando, $350,000 house in Memorial, and it was a fix and flip, and he never even found that out, and so we get all the way down to the end, and then underwriter, boom, hey, you need another appraisal. Well, we're supposed to be closing today. Well, sorry, you can't close. You need another appraisal. And then the investor gets pissed off that owns the house, and he takes the house off the market, and because we're out of contract. And so we have to go back in there and fight for the deal and have the buyer put up more earnest money to extend it. And then we closed it, but the point is that it's not the way to do business, and you have to get this stuff addressed up front. And so because he's not going to get any referrals from that realtor, and so so you got to be on your A game with some of these things and find out, ask these questions. After 6 months, it doesn't matter. Then after that, so that's a good one. That's something that can come up. So when you guys quote payments, when you quote payments, or Sean or Scott, when you guys are quoting payments, how do you quote a payment to a customer?
Never come up.
Huh?
Hardly ever come up probably less than 10% of the time as far as payments. If I do quote a payment, I use the mortgage calculator, and I use the formula that's in there, and then manually add the insurance, manually take a stab at the hazard insurance, and look on the property tools for the taxes, and I add all that together.
Okay.
And most of the time, it's just principal and interest. I don't really quote them with the insurance and everything, because that's really it could vary.
Right.
That's the answer, man.
But it rarely comes up. They rarely ask for that.
Yeah. Well, I know, but once you get deeper into this and you're doing more loans, and it'll definitely come up. And you want to quote just P&I, principal and interest, because if you quote the wrong numbers for taxes and insurance, then yeah, you can scare them off because they're gonna think that, like, if you grab the wrong thing online for insurance or taxes, they're gonna get another quote from another lender, and the other lender's gonna give them different information.
They're gonna go with that.
They could. It's happened to me many times.
And oftentimes, if the other lender is quoting principal and interest, and then you want to, quote the PITI, from the customer standpoint, they just see you just being that much more expensive. It's not even apples to apples. So
I kind of, I don't want to say I disagree, but if you explain it properly, I would say like, hey, listen, this is the principal and interest. I'm taking a stab at guesstimate at the total. Now, if they're asking that, they want to know what they total payout. That's only a situation that I had. But all right, I want my note to be around this much all out. Then I will try to backdoor and figure out, how much they could get approved for. So I mean, or how much is going to be around that price range that they're looking for.
Yeah.
So I mean, it's just a matter of explaining.
But in dealing with people, though, here's the thing about it. You can explain it. I'm just being straight up. You can
Right,
explain it as articulately, as methodically as you would imagine a 6-year-old would understand it, and they'll still get it misconstrued if someone else quotes them something different that's less. Because it ain't about what they remember. I mean, it's not about all the stuff you gave. It's only what they remember, and all they can remember is that payment.
Yeah.
And if they hear that your payment is $1,200 and somebody else quoted them $655, they're going to be inclined subconsciously to go to the $655. So it's just better just to quote them the principal and interest payment, and then what we'll do, we'll work out the other, because we can't control what your taxes are, and you control what your insurance is by your homeowner's quote you get.
Now, let me ask you this, not to continue on, but this is just so simple. If somebody is saying $100,000 loan, and somebody quotes you 500, and I quote you 1,000, wouldn't you think as a borrower that something's off with it?
You would think that.
You would think, but
Right.
we're talking about people,
Right.
B. People are a little crazy, man. They
I don't know, man. I just it's.
I just stick to the guns and just
Yeah,
do the PI.
I mean,
Yeah.
especially when you're dealing lending nationwide, tax rates vary so much. Like, I mean, like I didn't even know this. Like in parts of New York, that there's a huge variance in taxes.
Big time.
From
From the boroughs to the upstate.
Yeah.
I mean, but how, like, from what to what?
What do you mean?
Like, you say huge variance. And like,
Well, I'm thousands of dollars. I mean, it could be.
Can I give you an example?
Yeah.
I have if you're in one of the 5 boroughs, right? The taxes are very, very inexpensive, but the property costs a lot. So if in the Bronx, you can get for $400,000, you're getting a 950 square foot crib. I mean, seriously, it's a dinky house, but the taxes are cheap. But if you go upstate, you can get a nice house for that $400,000, but your property tax is gonna be $9,000. If you go to Rochester or up in Buffalo. So that's the main variance. That when you're in the inner city boroughs of New York, you get a little bit for a whole bunch of money. When your property taxes are low, but when you go out, it's ridiculously high.
Yep.
That's how. What's the guy's name? O'Neill. His taxes. He's up in Rochester. His taxes are like $7,400
Yeah.
annually
Yeah.
for $180,000 house.
Yeah. 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 It's like that, man. You got to know this, and I just don't want you guys to lose any loans. And so this is, the stuff that I'm telling you is just over years of experience. It's not like, I'm just trying to help you so you don't lose any loans. And these are best practices. When do you give a pre-approval letter to the realtor?
Only after interviewing with Christina.
Okay.
Yeah.
So,
is that true?
huh?
Is that true?
Now, you give a pre-approval letter to the realtor after they bring in their docs. After you get the minimal docs in, then that's when you send it to the realtor.
Yeah, I mean, the thing is that what you want to be careful of is the realtor that's going to be showing them the house. If it's through whether it's through Christina's network or it's on their own realtor, you guys need to have a conversation
Interview them first. Man.
with the realtor and interview them and ask them that questionnaire to at least have a chance to see if this person that we can work together. Because some of these realtors they're snakes. And I mean, you guys weren't, were you here, well, with his loan, right?
Yeah, I remember.
Yeah.
Heard it like took his loan and took it to somebody else.
Yeah, yeah. And so, you know, so you just gotta, you know, make sure that when you're talking to them that you ask them those questions, and you're gonna get a sense, I think. And a lot of times when there's money on the line, they may lie to you just to get the loan and say, oh yeah, I'm your friend, I'll protect you and I'll make sure I look after your loan. A lot of times what they're gonna do is take your customer and take it to their lender. Okay, and because they're in Arizona and you're in Houston, and who cares? They'll never see you. And that way they can get their 3% on the house, and the lender's going to give them probably about $1,000 on the loan as a kickback.
And incentivize your buyer to go with them by paying some of their closing costs.
So, you know, and it's just important. I think you
Right.
can talk when you talk to people, like, I think you can. When you start asking them, hey, I mean, just look at the questionnaire. I mean, so let's, hey, Hank, how's it going, man? You know, we're here in Texas. You're up there in Pittsburgh. I mean, how do you feel about working with a company in Texas? Is that kind of weird to you? You know, what do you do after I give you the pre-approval letter? Do you take it to your lender and shop it? You want to just throw those weird questions at him and see how he responds to it. You know, do you tell me about USDA? Do you know about USDA? Our buyers have no money. They need full concessions. Do you have a problem with that? They have no money. Well, I'll only do conventional. I don't know what a USDA loan is.
You'll be surprised when you're interviewing these realtors. You'll be surprised at how much they don't know. So that's for what I've looked. I'm talking to these realtors, and I'm like,
They think they know.
They think they know, but I'm like, I don't understand how they don't know. So that's what I found out in my time working here. Is
Yeah.
definitely ask some
But
questions.
I mean, you know, the thing is that you can see, like, from the people that have just been here a little bit, how he talks versus, you know, you being new, and how much he's picked up. You know, because, you know, it makes you sharp when you go through these things. And so, but yeah, you just gotta be very careful, man. That I mean, you know, there's good realtors out there, and you need to keep shopping for that one that, like, you know, I mean, you know, you have these loans in processing, you'll know when you talk to them. And so, and the thing is, you have to keep in mind, you're bringing them a gift, you're bringing them an opportunity, you know, and they need to really respect that and appreciate it. And so,
What questions do you ask?
there's a questionnaire, and some of those questions I just mentioned are in there. And so, it's real important that you do that. So Nick, I gotta ask you, how do we deal with builders?
How do we deal with builders? Well, definitely, if the client is actually looking at builders, I'm definitely going to ask them, you know, well, what's the name of the builder? So before they go inside that office and even talk to a builder, definitely call in and introduce yourself and trying to get an idea, and do the same thing that you'll do with realtors, and interview them and let them know who you are, and build that trust with them, you know. So that's what I've done with my mistake, is definitely do that.
So win over the builder, win over the realtor,
Yep,
and potentially you can become a
Preferred
preferred
lender.
lender for the builder.
of course.
You know, if you do it right. You know,
Yeah.
but if you don't do that, then they will try and snake your deal.
Oh, they will.
You know, so you got to do this. You got to be proactive, because a lot of people, you know, 25% of loans that you're doing, they're going to be looking at new homes, new construction, and you got to get in front of that. You know, when you first talk to the realtor in the beginning, and they say, hey, listen, you know, hey, he's going to go look at new homes. That's fine. But here's how when you walk in there, you got to let him know his financing is already secured. Okay, he's already got the loan. He just wants to buy the house. All right, and they say, well, okay, that's fine. Well, we still want to present options to him. Say, no problem. Then let me talk to the lender. Let me talk to the builder. Let me show them who we are and what we can do, and how we're different, what we can offer. You know, and why we're working with him. And so, but you have to have those conversations, and you don't wanna go into a negative, like they're gonna try to do something, because if you do that, then you're gonna project that. You wanna go in there as like you're trying to develop a business relationship. That's the thinking you wanna have. And I think if you do that, it'll come off in your aura, and that's what you're trying to do, then they're gonna let you come in and close the deal. You know, I mean, I've done that with D.R. Horton in Texas, KB in Texas. Now that we're, nationwide, we've found that the different offices, they don't know, so we have to go into those different markets, like D.R. Horton in Florida, and let them know that we have a good relationship with them in Houston or in Dallas. And, and normally they'll just let us pass and bring the loan in. And so, but they will, the thing is that you have to explain to the customer how it works, that if they go with the builder's lender, that they're gonna pay it. The way it works is they're gonna be offered a lot of incentives, but there's gonna be a markup in the interest rate or in the price of the home in order to cover that. So they may say, well, if you go with our lender, we're gonna give you $5,000 in incentives. Okay, well, but the interest rate's at 1% higher, or the house is now $10,000 more. So there's no free lunch; it's being packed somewhere. And so, when you're dealing directly with a bank, you can get your funds directly, and you can get the best terms. But you can't stop anyone or steer anyone from not looking at new homes. They have the right to do that. But just know that if you have that conversation with them, then statistically you have the good odds at least salvaging a good percentage of them. And you won't be able to do everybody, but it'll at least give you the best odds. And the thing is that you want to get in with, like I said, ideally you'd love to get in with that builder. What about if you offered programs that the builder's lender didn't offer? 90% of the time, that's what we see, that the programs that we offer, the builders lenders don't do that because they're just mortgage companies, and they don't have all the stuff that we do. So they may be interested to see that, hey man, look at all these programs this guy offers. You see him as an ally, and he can help us make more money, right? So, that's a really important thing. Let's see here. This is a good question right here. If a home is worth $200,000 and I buy it with a conventional loan with 5% down, for $140,000, I can waive the PMI since there's 20% equity. So let me say that again. The house is for sale for $200,000. It's for sale for $140,000. It's worth $200,000. It's worth $200,000. I'm buying it for $140,000. So the house has $60,000 equity. So I'm going to put 5% down, going conventional. So can I waive the PMI because we have the $60,000 in equity? Yes. What do you say?
Yeah, because I'm doing the same thing.
What do you mean?
Exactly the same. My house worth $211, and I'm getting the refinance to drop the PMI.
No, I'm talking about when
That's
you
different.
purchase. I'm
It's
talking
so
about when you
different.
purchase it.
Even with prices, just 20% room.
Same thing.
Yeah, the same thing.
Still got the equity in it.
Right.
Is that what you guys think?
Yeah.
What do you think, Scott?
We're talking about
This is number
194.
194.
It's an awesome deal. It's an awesome deal.
I got it wrong, but I know what the answer is now.
I got it wrong.
What do you mean you got it wrong?
You know what it said? You told him.
I mean, I understand why, but
Okay, you're saying that you can waive the PMI, right? That's what you guys are saying?
Yeah.
Okay.
Yeah. Now, my question is what if this is the same situation, but it's FHA, and they're just putting 3.5% or maybe 5%?
Well, the answer is that you cannot waive the PMI.
Right, you got to get it reappraised after you buy it. Because that's why I said yes, and then I thought about it afterwards. No, that's not
It's
correct.
the lower of the price or the value.
Right.
Why would you have to
wait,
get rid of
I put false but got it wrong.
I put true and got it
I
right.
got
Because-
true and got it right.
Because if a home is worth $200,000, I buy with conventional down 5% down for $140,000. I can waive the PMI.
That's false.
Yeah, it's false.
So the answer is false.
I put
Yeah.
false but got it wrong.
Yeah, and we put true and got it correct.
No, it's false. So,
I thought so.
yeah, it is false. Okay, yeah.
Okay. I was-
Yeah, it is false. Yeah, they go off with the lower of the two.
The lower, this
Yeah.
is just the two appraisals.
Huh?
Two appraisals.
No, not to appraisal.
The
So,
lower of the two values.
so if the house is worth 200 and the price is 140, they're going off of either the lower of the value or the price.
Oh, okay.
So they're going off of the price, and you're putting 5% down on the 140. So they're looking at as 95% because you purchased the house for 140.
Gotcha.
So you'd have to come back with an appraisal,
Get it reappraised.
reappraised to remove the PMI. And normally they're not going to remove the PMI until you make at least 6 to 12 payments. See, it's a misconception, but in FHA the PMI stays on there forever.
Forever.
Yeah, for a 30-year loan. So I gotta fix that. I put that in there incorrectly, but it's actually, you know, you can't waive the PMI. Now, there are programs that have no PMI. There are conventional programs. There's many conventional loans. There are conventional loans with no PMI too. You can price a loan with PMI or without PMI for conventional. You can also, what we learned the other day is that you can do a combo loan. You know,
Combo.
80-20, 80-10,
yeah. Well, the 80-10 is here. The 80-20 is
80-20.
is gone.
Oh, really?
Oh, yeah, they're not gonna let that come back. So, but there's an 80-10, and that can get rid of the PMI. And we learned a little bit about that, a few days ago. And it can really be a very, the first loan I ever bought my house was with an 80-20. And the reason why you do that is because it ends up, what happens is you get two loans. You get a first loan, and then you get a junior loan for smaller. And by doing that, the second loan is for 20% or 10%, so that way you can waive the PMI. And what ends up happening is that your house payment will be cheaper with the two loans versus the full payment with the PMI. So, like right now, Fernando has a loan in Florida. It's a $400,000 purchase, and the payment is $2,500 with the PMI, and with the combo loan, the payment is $2,350. So it saves her $150 by doing the combo loan. And see, what happens is when you have the combo loan, you can pay off the second lien faster because it's a real small loan for like 20 grand or something. So then all you have then is your big loan with a lower rate and lower payment. But if you go with a full payment with a full PMI, you're stuck on that forever, or until you have the 20% equity. So this, like really smart people, they do combo loans, or they do, well, I'll probably start doing adjustable rate mortgages again. If rates keep on going the way they are, that'll come back into the market. It hasn't been something that's even been, a desire because the rates have been so low. But if rates start to go up again, adjustable rates will, be a favorite again. And so I'm going to do a training on combo loans, so don't worry about that. It's going to be for more sophisticated people though. I mean, your first-time buyer is probably not going to even think about that. So, but if you're dealing with some bigger customers, they're going to want to do that.
I have a question regarding the adjustable rate mortgages. If the interest rate is climbing, why would you want to sign for an adjustable rate mortgage? Why wouldn't you want to sign a fixed at the low interest rate?
Yeah, so it depends on the market environment. Right now, you would not want to do that. But let's say it's 2006, and and that will happen again someday. When that happens, and the 30 year is at 6.5, and the ARM's at 3 for the first 5 years, and then after 5 years, then it has a cap on how much it can adjust every year, 1% up or down.
You could also refinance
Yeah,
before the 5 years.
and you're not going to, most likely you won't even be in the house for 5 years.
Yes, think about it.
Yeah,
Makes sense.
yeah, so now it doesn't make sense to do it, but it could, once rates go up again.
So they used to do those 228s, and that wasn't really giving people enough time to build any kind of equity in their home or even get their credit situation back in order. And then when that rate went up, you know, it went up 2 points or something, and it, you know, threw the payments way high. And it was sort of bad, so. I don't think, they're not gonna go back to those short-term arms, you don't think, right?
They do have them, but they don't have, they have 1 year, they have 2 year, but they don't, the thing with the problem with AmeriQuest, what they did is they put them in a 5-year prepayment at the same time that they were on a 2-year adjustable, so it really, choked the customer. And so, to where they got screwed big time. And so, now, they're very restricted, like, you know, they can only move up 1%. On the AmeriQuest adjustable rates, there was no, on some of them, there was no cap. So you could start out at 10, you know, or back then, that's what we were doing, selling 10, I was selling 10% rates, but, and then after the 2 years, it could balloon to 17, you know, and that's how people were going to foreclosure. Is because after that 2 years is up, it was an explosion to the rate. It wasn't just like, you know, 10, 10 and a half, it was 10, it could go to 12, it could go to 14, I mean, and you get calls from people, their payment would literally go from $1,000 a month to $1,800 a month.
Wow.
And they're like freaking out, they don't know what to do. And they're in foreclosure. And so I remember it was a way different time, but, anyway, so, let's see. Medical disputes for FHA, they don't count?
Yeah, they do. Not in medical.
Medical disputes for FHA, they don't count.
It's just $1,000, it's regular collections, $1,000 or less.
So
Not collection.
so it's true, medical disputes do not count.
Right.
I put true and it counted as wrong.
You did too, bro. It was right.
No, it says true. It says correct.
Oh, wrong one.
FHA, it's
For
true.
number
What number is that?
189. 189, yeah, it is true. Yeah. So make sure that you guys understand. So if you have an FHA loan and you have accounts in dispute that are medical, it doesn't matter. For medical. If they're non-medical, it does matter. If they're, you know, if it's sub 1,000, it's okay. But if it's over 1,000, then it would be downgraded to a manual.
What if they're not disputed?
That's fine.
Okay.
Yeah, we're just talking about disputes. The point is that the thing here that we're trying to point out is that the dispute part. And so for FHA, if you have medical accounts that are in dispute, it doesn't downgrade it to a manual underwrite. But for USDA, the question above that for 188, medical disputes for USDA do not count, and you put false. So, or who answered this? Jason?
Jay.
Okay. And he put false, that's correct. So what does that mean? That if you have accounts in dispute that are medical for USDA, it does count.
That's what
Yeah.
I was thinking.
See, this is where it can get tricky because one product says it's okay, the other product says it doesn't. So for USDA, if you have accounts in dispute and they're medical, it does matter. It falls within the threshold of $500 or less, and they have to be over 2 years old.
Just think about it, that USDA is a little bit pickier. 'Cause
It
you're
is pickier.
You're borrowing 100%.
Yeah.
So they're less
Right.
lenient.
Right. Right. So it's just paying attention to these little details right here, because let's say you get a loan that you're trying to go USDA, like DERF or whatever, and there's a medical account that's in dispute, and it's $1,000, that's an issue. But if it's FHA and it's medical and it's in dispute, it doesn't matter. It's just, you know, seeing that and knowing that. So,
Oh, you're at 44 minutes.
oh, okay, hit stop.